Hello learners, welcome to today's class. And today's class, I want us to look at something in accounting. Now imagine you are employed. In a factory X. Let's say in a factory X. Now, in this factory X, you will notice that they are producing something like a chemical. They are in a manufacturing industry, but they are doing chemicals production. And then, through your understanding, after sometimes you notice that this chemical is produced in steps. Then you notice that there is step 1, step 2, and even step 3 for them to get the finished product. It takes step 1, step 2, and step 3. You are an accountant, and therefore, as an accountant, you will be required at the end of the financial period to tell the management the cost you have incurred. Therefore, you will be accounting for all these 3 steps. If that's you, then you will simply call this then process accounting for processes. You will simply call it accounting for processes. That's what we are going to talk about today. Accounting for processes. Accounting for processes. In here, what you will be accounting for is specifically what you will be accounting for in these steps are the costs. The cost of materials being introduced, the cost of labor, and the cost of overheads in each and every step, of which now we call process. So in each process, you will want to understand how much was spent at the end of that financial period. And therefore, what you will be more keen on, so that you can give a conclusive report to the management, will be the costs. And under this cost, remember, under this cost includes what went wrong. It includes what went wrong or what didn't go to according to expectation, or something that did not give the value that was given in. Now, therefore, you will further name it process costing. But because there are some things that didn't go right, then you will call it process costing with the presence of process losses and gains. Because even if things go wrong, sometimes things also go right. That's why we call it process losses or gain. So we want to look at what entails in this accounting topic. Now, as you continue the process, you notice that during the manufacturing, there are some things that do happen. And then the material sometimes can end up being discarded. The materials might sometimes end up being discarded. And then they result into waste. They result into waste. At the same time, this waste, you can call it a loss. You can call it a loss. Now, you can call it a loss. But during this period or previous period, it has been examined that there are some of this waste that occurs, but they result from things that you cannot control. No one can control. Some of the things, for example, in a chemical industry, that can lead to waste or loss is like evaporation. No one can control evaporation. So we call them, because they continue occurring and there is no control over them, you have no control over them, we call them normal loss. Normal loss. You have normalized them, so you call them normal loss. But because you don't want to incur a huge cost, you want to do everything possible to reduce the cost. Therefore, you want to do everything possible to reduce the cost. Therefore, you will try to get something from these losses, something from these things that you discarded, something from these things that you could not use in your processes. And therefore, what you will want to do, is maybe to find out if there is a price or where you can sell this product to get something out of them. So, therefore, you sell them to somebody as a scrap. And therefore, from there you find the word scrap in your accounting. Scrap. Scrap, scrap, scrap. Meaning, they are losses or they are waste, yes, but you can sell them and get something back. So you sell them as scrap. You sell them as scrap. During this process, remember this loss, normal loss, you cannot control it. But some things do happen. Sometimes things do happen. Sometimes things do happen. You are in a chemical producing industry. Therefore, there are mixing of different type of materials to get the chemicals or the product you wanted. One of the things you have noticed is that due to weather, the normal loss then can result from evaporation. But also, there is mixing. There is mixing. Therefore, if there is mixing, then the ratio of mixing can sometimes go wrong. The ratio of mixing sometimes can go wrong. Maybe the person who do the mixing might not be experienced enough or informed enough. And therefore, you end up incurring loss due to negligent or lack of full information from whoever doing the mixing. Then that loss is something that do not occur every day and you can control it as well. That is what we call abnormal loss. Normal loss. It is what we call abnormal loss. Despite that, you notice that even if the weather is bad on your side and cause evaporation, there are some times that evaporation might be low. There are sometimes evaporation might be low. It doesn't occur all the time, but once in a while it might be low. Or the person doing the mixing has done it several times, and he now has a lot of experience. He or she has a lot of experience. So due to that experience, he reduces the loss. The loss occurs, but now the loss is very minimal. This normal loss that always occur, that you always incur, is now very minimal. And that's when we come up with what we call abnormal gain. Abnormal gain does not mean you have like increased you have gotten something out of what you are from nowhere on what you are producing, but you have significantly reduced this what we call normal loss. So when the normal loss is significantly reduced, then we get abnormal gain. Now, having understand that, we now want to look at how do we account for processes, or how do we come up with the costing? How do we come up with the cost of the final product in process accounting? How we come up with the final cost or final value of the final product or the product you have produced. Therefore, we are going to look at this by the use of an example. I'm going to use an example. Keep those words that I've written in your mind, because we are going to encounter them on our way. So, we are looking at an example. Example. Now, here's the question, illustration. ABC Chemicals Limited manufactures a chemical compound X. Used in making plastics. This chemical is used in making plastics. The chemical compound involves two processes. Process A and process B. The output of process A is passed to process B. That means what you get from your first step one, which they call step B, step A, accounts as the raw material for process B. It is taken to process B for further processing, which means that some materials and some chemicals also are going to be mixed at process B with what you got from process A. Okay? The output of process A is passed to process B, where further material is added to mix. The details of the cost for the production period ended 30th April were as follows. Direct materials 500 kgs at shillings 10. Direct labor 40,000. Process plant time 200 hours at shillings 220 per hour. Overheads shillings 20,000. Process B, direct materials 3,000 kgs at shillings 10 per kg. Direct labor 25,000. Process plant time 120 hours at shillings 220 per hour. Overheads shillings 12,000. Additional information. The expected and actual output for the process was as follows. That is process A and process B. Expected output, process A, 90% of input. Process B, 95% of input. Actual output, 4,200 kgs. Process A. Process B, 7,340 kgs. Assume no additional information 2. Assume no finished stock at the beginning of the period and no work in progress at either the beginning or the end of the period. This simply means that at the end of this process, at the beginning of this process, there were no opening stock. There were no opening stock. And at the end, there is no processing that can take place further. So, what we get at the end of second process, or process B, is the final. Now, additional information 3. Normal loss is sold as scrap. Normal loss is sold as scrap for shillings 1 per kilogram from process A and 2 shillings per kilogram from processes B, for both of which immediate payment is received. In other words, they are being sold in cash. Now, what are we required to do? Process A account and process B account. Now, process A account. Let us start with process A account. A account. A account. Process A account, we have particulars, then we have units, then we have amount in shillings, that one on the DR side, then on the CR side, we have particulars. We have units. Then lastly we have shillings, the amount. Now let us believe this is CR, this is DR. Now, what are we being told? Let us go back to our question. Okay. Process A, start with direct materials at process A were 5,000 kgs at shillings 10 per kg. So the input was 5,000. The input here was direct materials. At 5,000 shillings. 5,000 unit cost was 10. Then therefore we have 50,000 total cost. We have direct labor. Direct labor costed 40,000. Direct labor was 40,000. Then we have process plant time, which is 200 hours. 200 hours as to 20 shillings. 200 hours. We have 200 hours times 20. That's give us 40,000. That's give us 44,000. 44,000. Then we have again overheads. We have overheads. I understand. I believe you understand what is overhead. Overheads are the expenses that you incur, e.g., lighting of the room. As an individual, you are an accountant, you are not engaged in manufacturing, so your salary becomes an overhead. Another thing is maybe water, it's also an overhead. The things that you use in the factory, but not directly involved in producing that, they are indirectly involved in producing your final product. So they become overheads. Now, let us continue. Additional information. Good. We had overheads. Overheads here were overheads cost 20,000. Now, when you look at this, this will give you the cost of the input, the total cost of input. The total cost of input will be this, the addition of all this, will be addition of all that, okay? So, cost of input, your cost of input, cost, let us use this as workings, this side will be workings, so this is cost of input, cost of input. Total cost of input is 50,000, 40,000, 44,000, and 20,000. 50,000 plus 40,000 plus 44,000 plus 20,000. You get 154,000. You get 154,000. That's the total cost of input. Now, we go to the additional information. The expected and actual output for the process was as follows. Expected output, actual output. Now we are looking at A alone. So, expected output is 90% of input. 90% of input. That is 0.9 times. What was our input? Direct materials. What was our input? Direct materials. Direct materials there is 50, is 5,000 kgs. 5,000 kgs. So what we will get as our expectation, that is will be, that one is after removing the normal cost, the normal losses, not the normal losses, 0.9. Remember, expected output is the amount we get, or the result we get after subtracting normal loss. So that is 0.9 times 5,000. We get 4,500 kgs. That's what we expect. But due to other factors, we get what we call actual output. What we really got, what we actually got at the end of it. What we could count, actual. That's what we call actual output. Actual output here is 4,200 kgs. And what we actually produce is what we take to process B. Therefore, this actual output is what we take to process B. So here we go to process. We credit to process B with 4,200 kgs. We credit process B, credit this side because that's what is going out. We credit it because it's going to process B, 4,200 kgs. But we don't know the value. We don't know the value. So how are we going to get the value? We don't know the value. So how are we going to get the value? Now, if we want to get the value, then we must find out our normal loss. Remember, normal loss in this scenario, we are being told it was sold. When a normal loss is sold as a scrap, then it reduces the cost of input. It reduces the cost of input. It is like you expected something, but unfortunately, you got a value out of what you did not expect to get value from. So the cost of what you expected will be less the value of what you got from what you expected as a loss. Therefore, we look at normal loss. Normal loss. What is our normal loss? What is our normal loss? Normal loss is the difference between input and expected output. The difference between input and the expected output. What is our input? Our input was 5,000 kgs. Our expected output was 4,500. So we subtract 4,500 kgs. Therefore, our normal loss is 500 kgs. Okay? On this here side, you are going also to credit normal loss. You credit normal loss. Normal loss. 5 kgs. 500 kgs. These are in kgs. Now, what is the value of our normal loss? We are told it was sold at 1 shilling. It was sold at 1 shilling each. So, the value here therefore will be 500 times 1. It is give us 500 shillings, 500. That's what we get here, 500 shillings. That's what we credit, 500 shillings. Now, we want to get the value of our actual output. The value of our actual output. Okay? Before that, we must get the value of our output. Now, how do we get that? Now, the value of our input alone, this value here, the value of our input, therefore, value of input, therefore, will be the cost of input minus the value of normal loss. So it is 154,000 minus 500. 150,000 minus 500. What do you get from there? What do you get? 154,000 minus 500. You get 153,500. 153,500. Now, what is the unit cost? What is the unit cost of our expected output? Unit cost of our expected cost. Expected output. Unit cost of expected output The unit cost of our expected output therefore would be the value of input divided by the expected output in units. The value of our input divided by the expected output in units. So that is 153,500. We divide it by 4,500. What you get? Divide it by 45. So this gives you 34.111. 34.1111. We use 4 decimal places. As an accountant, you should know that. You use 4 decimal places. So this is the unit value. This is the unit value of our output. Our actual output was 4,200. 4,200. So we multiply that by that one, by 34.111. So 4,200 times 34.111. You get 143,267. You round off to the whole numbers. If you round off to the whole numbers, it is 67. Now, we get that, okay? This is what we take to process B. We continue. From the look of things, what we expected is not what we got. What we expected is not what we got. We got less than what we expected. If we happen to get less than what we expected, then something went wrong. And what went wrong? Maybe there was mixing problem, or the evaporation exceeded the rate we expected. Therefore, we incurred abnormal loss. So how do we get our abnormal loss? Our abnormal loss will be expected output minus actual output. Expected output minus actual output. 4,500 plus 4,200. What do we get? 300 kgs. So this is what we credit, abnormal loss. Now, this is our abnormal loss. What is the value? It is 300 kgs. Yeah. Now, what is the value of our abnormal loss? Remember, we were not expecting to get that kind of a loss. So we don't account for it as if it is something normal. Okay? So what we do, we consider it as part of our final product. We consider it as part of our final product. Therefore, if it is considered as part of our final product, therefore, the value per unit is the same as the value per unit of our expected output. The value per unit of our expected output, we got 34.111 shillings. So that is what we do here. 300 times 34.111. We do that times times 34.1111. That becomes 10,233. As an accountant, you must be very keen to see if your account has balanced. If your account has balanced. If it has balanced, then you are on the right track. Then what you have done is probably right. Now let us add the debit side and the credit side and see if that is the case. If that is the case. Start with the units. This is 5,000. 4,200 plus 500 plus 300, it gives us 5,000. Up to that point, you are right. Up to that point, you are right. Now, on this side, we got, on the debit side, we got 154,000. Here, we got 154,000. Now, we look at 154,000 this other side. That is 14,3,267 plus 500 plus 10,233. We get the same 154,000. And then you are right. You close your account. You close your process A account. You close your process A account. Close your process A account. Now, let us create a space so that you can proceed to process B. This is our working area. Let us do process B. B account. The same thing you do here. Same thing. You have particulars. Your units. You have units and then you have shillings amount. The amount in shillings, then you have particulars. We have units, then we have shillings, the amount. This is C, credit side, and then this is debit side. Yeah. The ruling. Very good. Up to that point. Now, we start the same way. Remember, this is what we were told. The output of process A is passed to process B, where further material is added. It is therefore the output of process A is passed to process B. What was the output of process A? This one. Process B to process 4,200 to process B. Now here it becomes from process A. Now we call it from process A, and that is 4,200 kgs. At what price? At what cost? 143,000. 267. What happened during that process? We are told in process B, direct materials were added. That 3,000 kgs. Direct materials. 3,000 kgs. 3,000 kgs. This is kgs. 3,000 kgs. At what price? At 10 shillings each. That gives us 30,000. 10 shillings each. That gives us 30,000. And again, we go ahead. Then we have direct labor. We have 25,000. Then we have process plant time. We have 120 hours at 220 shillings. We have 120 hours. 120. That is 120 times 220. That gives us 26,400. That gives us 26,400. Then what we have again? We have overheads. We have 12,000. Now, what is the total cost of our input? It is the addition of that. Input. So it is 143,267 plus 30,000 plus 25,000 plus 26,400 plus 12,000. That gives us 236,667 shillings. Okay? Shillings. That's what it gives us. Now, expected output. Our expected output was 95% of input. Our input here is these two, 4,200 and 3,000. That gives us 4,200 plus 3,000 gives us 7,200. 7,200. This is this plus that. Okay? 7,200 comes from 42 plus 30. 4,200 plus 3,000. 4,000 plus 3,000. That times what? Times our expectation, which is 49%. That is 0.95. 0.95. Now, 7,200 times 0.95. 0.95, that gives us 6,840. 6,840. Now, what is our actual output? Actual output we have been given. Actual output. Our actual output is 7,340. 7,340. So here we have our actual output. Okay. 7,340. 7,340 kgs. All these kgs. Now, now what is our normal loss? What is our normal loss? Therefore, normal loss. What is our normal loss? Then normal loss, as usual, normal loss will be 7,200 minus our expected output, which is 6,840. That's our normal loss. The loss that we know we are going to incur, no matter what. So that one gives us 7,200 minus answer, give us 360. 60 kgs. So normal loss here. Normal loss. We have 360 kgs. Normal loss we have 360. Normal loss we have 360. Okay? Okay? Now, from our looks, from the looks of things, from our looks, we have noticed that we didn't have abnormal loss. But we had again, because our expected output is 6,800, but actual output is 7,340. 7,340. 7,340. Now, here, therefore, our abnormal gain. Yes, here we have abnormal gain. Our abnormal gain, therefore, it is our actual output is 7,340 actual output minus expected output is 6,840. What do you get? So 7,340 minus 6,840 give you 500, yeah? 500 kgs. Because it is again, something you gain, then you debit it. You gain, so you debit it. Abnormal gain. How many kgs? 500 kgs. Okay? 500 kgs. Now, we want to look at now cost per unit. Cost per unit. Cost per unit. But before doing that, we are forgetting something, a process that we are skipping a process that we looked at in this process A, and that's getting the cost of the cost of, or the value of output, the value of our expected output, okay, per unit, the value of our expected output per unit, value, or the value of our expected output, value of expected output, value of expected output. The value of expected output then therefore becomes cost of input minus the value of normal loss. The value of normal loss. What our normal loss, value of normal loss, loss here is 360 times what it was sold. It was sold at 2 shillings. 2 shillings. This is 720. Now this is what you get. Subtract to get that. That one will be 23,260. 667 minus 720 minus 720. What do you get? Minus 720. Minus 720, 23. 667 minus 720. That one gives you 23, 594, 7. 23, 594, 7. 23, 594, 7. Now, cost per unit, therefore, cost per unit, therefore, cost per unit, per unit, therefore, is equal to this value, the value of our expected output, that is 235,947, divided by our expected output. Our expected output is here 6,840. 6,840 divided by 6,840. That is 34.4952. 4952. Now, up to that point, we can now get the value of actual output and abnormal gain. Abnormal gain is also treated almost the same as abnormal loss. It is considered to be part of our actual or part of our expected output. So its value per unit is the same. Its value per unit is the same. This value per unit means the same. Now, here, abnormal loss, we know very well it was sold at 2 shillings each. So this is 720. 720. So 730. This now actual output. Therefore will be 7,340 times this 34.144952. And then abnormal gain will be also the same. 500 times 34.4952. 4952. Now, let us start with the 7340 times 34. 952. 492. There's a problem somewhere. this point. And then that gives us 2, 5, 3, 9, 5. Round off the whole number. Round off the whole number. Then we have 500 times the same. Just go back on your calculator. That gives us 17. 17,248. Round off. Round off. Round off. Now, let us try and do the balancing of our account. Balance our account. Do the balancing of our account. Let us do the balancing of our account and see if you are right. Now we start with the unit side. That will be 4,200 plus 3,000 plus 500. You get 7,700. Now this side also 73,40 plus 360. We get the same 7,700. Now let us look at this side, the amount side. We have 143,267 plus 30,000 plus 25,000 plus 26,400 plus 12,000 plus 17,248. What do we get? 25,000. 3915. Then we look at this other side is 25.